Welcome to the Riskwiser Zone, the podcast where we dive into the world of finance, technology, and global markets. I'm your host, Louie, and I'm excited to share today's episode with you. We're starting off with a fascinating story that highlights the complex dynamics between the US, China, and the tech industry. You may have heard about the US chip export controls imposed on China, aimed at curbing China's military advancement and protecting US dominance in the AI industry. However, according to Jensen Huang, the CEO of NVIDIA, these controls may have had an unintended consequence. Huang recently stated that the export controls have actually spurred Chinese companies to accelerate their own development, making them more self-sufficient in the process. He even went so far as to call the controls a failure. This is a significant admission, considering NVIDIA has been directly impacted by these restrictions, writing off billions of dollars in sales and seeing its share of China's AI chip market decline. This story raises important questions about the effectiveness of export controls and their potential to drive innovation in countries like China. On one hand, the US government is trying to protect its interests and prevent sensitive technology from falling into the wrong hands. On the other hand, these controls may be pushing China to develop its own capabilities, potentially creating a more level playing field in the long run. The Chinese government has responded strongly to the US warnings, accusing the US of bullying and protectionism. This rhetoric highlights the tense relationship between the two nations and the ongoing competition for dominance in the tech industry. As we explore this story further, it's essential to consider multiple perspectives and avoid taking sides. The implications of these export controls are far-reaching, and their impact will be felt across the global economy. We'll be right back with more from the world of stocks and finance on the Riskwiser Zone. Welcome back to the Riskwiser Zone. We're glad you're still with us as we dive into the world of global economics and energy security. Our middle segment today takes a closer look at a critical issue that's been making headlines lately: the concentration of critical minerals for clean energy in just a few countries. According to a recent report by the International Energy Agency, the average market share of the top 3 producing countries for key minerals like copper, lithium, and cobalt has increased to 86% in 2024, up from 82% in 2024, up from 82% in 2020. China is leading the pack, with an average share of around 75% in refining these strategic minerals. Now, this trend raises concerns about supply chain vulnerabilities and the potential for trade disruptions. As EA Executive Director Fatih Birol notes, critical mineral supply chains can be highly vulnerable to supply shocks, be they from extreme weather, a technical failure, or trade disputes. This could lead to higher prices for consumers and reduced industrial competitiveness. It's worth noting that market forces are important in developing new sources of these critical minerals, but government policies will also play a crucial role. The US, for instance, has been looking to reduce its dependence on foreign critical minerals as part of its national security and economic resilience agenda. On the other hand, some countries like Indonesia are showing strong growth in producing key minerals like nickel, which is essential for electric vehicles and steel production. However, the current trend towards export restrictions and trade disputes only adds to the uncertainty surrounding global supply chains. As we consider the implications of this report, it's clear that diversification will be key to ensuring energy security and economic resilience. As Birol puts it, the golden rule of energy security is diversification, and it goes beyond energy security. It is also economic security. We'll continue to monitor this critical issue and bring you updates as more information becomes available. For now, it's essential for governments, industries, and consumers to be aware of the potential risks and work together to build more resilient supply chains. Stay tuned for our final story of the day, right here on the Riskwiser Zone. Welcome back to the Riskwiser Zone. We're approaching the end of our show, but we still have some exciting news to share with you. Today, we're going to talk about two interesting developments in the market that caught our attention. First up, let's take a look at the Leela Hotels IPO and Bell shares. Now, I know some of you might be thinking, Lewis, what's the connection between these two? Well, my friends, both stories highlight the importance of staying informed and adapting to changing market conditions. The Leela Hotel's upcoming IPO has set a price band of $103.17 per share, aiming to raise around $1,000 crores. This is an interesting move, considering the current state of the hospitality industry. As we've discussed before on this show, the pandemic has had a significant impact on the sector, but it's also created opportunities for growth and consolidation. On the other hand, Bell shares have surged over 4% to hit a fresh 52-week high after November raised its target price post-strong Q4 results. This is a great example of how a company's performance can exceed expectations and lead to a re-rating. Bell's Q4 margins rose to 30.6%, surpassing street expectations, and the management has maintained its guidance of 15% revenue growth and 27% operating profit margin. Now, I want to emphasize that it's essential to approach these developments with a balanced perspective. While the Leela Hotels IPO and Bell shares might seem like exciting opportunities, it's crucial to consider the risks and challenges involved. As we always say on this show, don't put all your eggs in one basket. As investors, it's vital to stay informed, diversify our portfolios, and be prepared for any eventuality. Remember, the market can be unpredictable, and even the best-laid plans can go awry. That being said, we're not here to spread doom and gloom. We believe that with the right mindset and a solid understanding of the market, you can make informed decisions and achieve your financial goals. So, what can we take away from these stories? Firstly, it's essential to stay up to date with market developments and adjust our strategies accordingly. Secondly, diversification is key to managing risk and maximizing return. And finally, always keep a level head and avoid making impulsive decisions based on emotions rather than facts. That's all for today's Riskwiser Zone. Remember to like, share, and subscribe. And until next time, invest with caution.